Morning, my name is Przemysław Kwiecień. You're watching XTB weekly trading webinar. So today we are going to discuss stagflation to begin with, and is this scary word something that could be brought back from the 80s? This is something that we'll discuss today, obviously on top of the other things like bond yields, euro dollar, Nasdaq, gold and oil. So let's begin because there is a lot of material to study, and traditionally here we start with the top news of the Monday morning, which is definitely the oil market that sees very high levels. For Brent, it's above 70 for the first time since pandemic began, and for oil WTI it's actually the highest point since 2018 after attacks in Saudi Arabia, adding pressure to inflation concerns, adding pressure to oil prices. So this is something really really important to be reminded. This oil market is in a very strong upwards trend. The attacks themselves, they are responsible for the gap today in the morning. Let's take a look at the market here. Yeah, so here we have oil WTI chart. As you can see, pretty much since the vaccine news over here, oil market has been on the upwards, very strong upwards trajectory, and this trend has been enormously strong. And as you can see, this lower limit proved to be a strong support on numerous occasions. And today, like I said, these attacks, this is just a tiny point here. So it's not like the attacks in Saudi Arabia are responsible for expensive oil that we have today, at least expensive in terms of past year, but they're just adding fuel to the fire that was there anyway. So with the attacks, they are described as relatively innocent and not having much impact. So I would expect them to actually wane off. I mean, this impact wane off, and probably we can the price can pull back a little bit towards the inside the channel, but the trend remains very strong. As you can see, we had 3 strong days last week after the oil decision, OPEC decision to contain output for a few more months. So the clearly strategy, especially of Saudi Arabia and the other OPEC countries, is to tighten the market, to have higher oil prices. And first of all, this is important because this keeps this trend alive. But secondly, obviously for us, this means that these bond yields continue rising, and this intimidates other markets where the reactions so far were fairly mixed. As we can see here, the third point, mixed opening after a very strong session Friday last week. Once again, it looked like maybe something could boil over, but then we had Friday, green Fridays in US, and very strong close to the indices. So today we have mixed open, but the markets are still a bit hesitant whether to yield to this it's funny, yield to these rising yields, or whether to ignore that. So certainly bonds are collapsing. US 10-year is already nearly 1.6. Quite soon it might be triple what we had in August last year. So it's certainly this is something to watch. And this week we're going to have US inflation reading on Wednesday and ECB meeting on Thursday. Key events that probably could impact this inflation story. But I'll return to this towards the end of our meeting today. Let's first start with the topic of the week and this stagflation thing. Why are we even discussing this? We are discussing this, first of all, because look, stagflation would be very bad for stocks, very bad, like very bad. You can see here that, and we discussed this on a couple of occasions, that high inflation is very bad for valuations. As you can see on this chart over here, it illustrates this very well, that if you have low inflation, I mean up to 3-4%, you can have very different levels of valuations, right? Whereas if your inflation goes up, these levels, this variety in valuation levels narrows down a fair bit, and these valuations tend to be very low. So obviously the risk of having, I don't know, 8% inflation today, it looks like completely remote, right? But the risk of having, I don't know, 4% inflation and muted economic growth looks to be something that is maybe not the baseline scenario, but something that we could imagine. And bear in mind, we discussed inflation last year, towards the end of last year, when no one discussed this. I mean, people were convinced we are going to have low inflation, we are going to have central banks printing money forever, we're going to have these sky-high valuations forever. Fast forward to present, and suddenly bond yields are on the rise. People are discussing why maybe this inflation is going to bite. So this is just a proof that sometimes it's good to open your mind to different scenarios that could not eventually materialize, but at least you as an investor, if you are looking at the S&P 500 valued at 39 of earnings multiple today, and you can see in this chart that it's definitely the upper level compared to the history, you're better be able at least to imagine what happens if. Well, so what is stagflation? Stagflation is pretty much a combination of high unemployment and high inflation. Pretty bad outcome, as I said at the beginning. If you ever studied economics, you had to come across Phillips curve, which tells you that if you want to have low unemployment rate, you'd run a risk of higher inflation, and vice versa. If you want to have lower inflation rate, you're going to have to deal with higher unemployment rate. This is something that central banks a few decades ago were convinced that was the choice for them, and if they wanted to cool down the economy a little bit, they will need to deal with higher unemployment. And then again, if they want to have higher employment, lower employment rate, they will need to tolerate slightly higher inflation. Then the 80s came, and we had the oil shock, and suddenly everything moved to the right, and the stagflation came, and suddenly many economies had both higher inflation and higher unemployment. And then they came the 90s, policies of targeting lower inflation that worked, and everything moved to the left. And many central banks started to say that, look, we no longer have these relationships. The Phillips curve is dead, and look at this data. Back in the past, there was a relationship, but right now there is no. We can have best of both worlds. We can have low inflation, we can have low unemployment rate, which was the case, and which led to high valuations in assets, because investors believed this good situation can persist. But it also means if there is no relationship between the two, they both can be high, right? They both can be low, which was the case, but they both can be high. And why are we're talking about this today? Let me return to this oil price chart for a moment to illustrate how monetary policy should work. So if you can imagine that this is economy and it grows towards some along some trend, and you have some volatility around this trend. So the monetary policy, what they should do, they should try to dampen this volatility to make the growth as smooth along the trend as possible. If it's smooth, the business is confident, they make more investment, they hire people, and the potential growth is higher, which means that the whole curve tilts upwards, right? But this is not what is being done today. But normally, and for most of the time, the angle of the trajectory is given by structural policies, which is labor code, taxes, institutional framework, trade policies, education, things like this, things that require at least some prudent thinking from politicians, and very often courage to tell people, look, we need to work harder, we need to increase taxes, we need to spend less on this, spend more on that. And politicians don't want to do that. They want to win elections, so they tell central bankers, hey, look, we cannot do this because we lose elections, so please lower interest rates, print some more money so we can, you know, kick this can down the road for another 1-2 years, and then we'll see. So this is what happens today, which means that looking back to this presentation, we may have a situation where central banks ignore a rise in inflation that may, you know, it may not lead to persistently higher inflation, right? But it may do, and if they ignore it like they do today, they tend to tell you, look, there is no inflation, we're not worried, we have everything under control, we keep printing money. That the result might be that after all these transfers, like Biden checks, things like this, after the effects of this weighing off, we may be left with higher inflation and still low economic growth. So this is, you know, it's still far from what we had in the 80s, right? So if you could imagine that the US could have double-digit, or UK double-digit inflation and double-digit unemployment rate, this is like horror scenario, and it still looks like completely impossible. But even inflation around 4% and unemployment rate above the average from past decade would be very bad from the markets that are being as high as they are today. So this is something certainly to be aware of, because we might have the situation boiling over you know, next 1-2 years, when inflation picks up, it's not being countered by central banks because they don't want to, and when the effects of this reopening plus transfers and everything, when it settles down, it might turn to be the case that the economies do not grow as fast as hoped, because, you know, there's a lot of hope and a bit too little of transparency in and logical thinking in today's policies. All right, so after this, I would say longer term economic framework discussion, let's move to the markets today, and let's move to indices and whether this increase in bond yields is going to hurt indices more seriously. So last week, the reason why we're discussing this, obviously one of many, is that we have this nice overbalanced structure on the Nasdaq 100, which is US 100 in our platform. An overbalance is a situation where you have a certain degree of correction, where you look at the chart and you say, okay, we had this in the past. Let's look at it live. We had it in the past, it worked, so maybe this is the similar degree, so this is a good moment to return to upwards trend. And it often works. When you look at the S&P 500, we had 3 similar corrections in the past. So looking at the range of correction is not a bad idea to begin with. And obviously the question now is, will that end this correction, or will we this time go deeper? So when you look at the Nasdaq, it certainly was very interesting towards the end of last week, especially with Friday's strong close. But as you can see today, the market's trying to push back, so it's still in play. So what I wanted to show you today is that when we look at S&P 500, where we certainly do not have this overbalance yet, right? It's more like similar profit taking to what we had towards the end of January. But if you take this one, actually there were 4, I missed this one, right? So if we put it here, you'd think, okay, we are pretty much far from it, right? We would need to be around 3,600 to which actually at the same time would be this top as a support this time. And that would be the overbalance, the true overbalance to look at. So what are sentiment indicators telling us? So I prepared a few of them for you, which I tend to look at from time to time to look for overheated or oversold conditions. And let's start from RSI, which on a correction level should be around 40, and it's 50. Then AI investor sentiment survey, it's still way on the optimistic side, whereas again, I mean, this one it's less regular. It's not like on a correction it has some level. So, but at least we can see that investors are very optimistic. It's not necessarily, as you can see, it's not always the top of the optimism here goes along with the market peak, but it tends to correlate, right? Like 2018, the peak in sentiment preceded the ultimate peak by not much, and then again in March or February 2020 it was similar. So either way, investors remain very optimistic. So this is not a contrarian signal. Deviation from 100-day moving average is still positive, whereas it should be slightly negative if the market were oversold. Put call ratio, which is option market indicator, where you have a lot of optimism. There's few put options because they are expensive. Why? To hedge your portfolio if you are optimistic. And there's a lot of calls because it's add leverage to your portfolio. So many people buy call options, and we can see that the market here is no longer at the bottom, but it's also not at the point where it could reverse lower, which would be around 0.6, looking at least at the recent volatility, because in the past it was higher. And finally, the VIX index, again, a stronger correction should any decent correction should take us to around 30-35 levels, whereas we are still below 30. So looking at these indicators, it's easy to say that the market is not oversold yet. Does it mean that we will go lower this week? Of course not. We don't know it, but at least it tells us, look, if you are looking for a midterm entry to the trend, this is not the point, right? So this is what this tells us. It doesn't tell us, look, this correction will go deeper this week. We don't know it. It's going to most likely depend on whether it's going to be further pressure on the bond markets, and will investors be increasingly concerned about the impact on the economies, and obviously on the asset prices. So finally, not finally, because we still have the ECB at the end of the webinar, but a short look on commodities. Are there any cheap commodities left? Where commodities were among the other among the assets that were gaining on this loose monetary policy. And even though you can see here that this overall Bloomberg commodity index is still very low, looking at the historical standards, it's because most of energy commodities, which still are fairly low, for instance oil price, we started to discuss at the beginning of the webinar. We are saying, look, it's 70 for Brent, wow, it's so high, but oil was nearly 150 in 2008, where this index was at its peak. Whereas here, this green line, it's a simple average of commodity prices, and you can see already that it looks fairly different, right? Because many smaller commodities are actually moving sharper. So which commodities could technically replicate what we saw recently on copper, where we had already upwards trend for quite a long time, and then the markets from already high levels, it actually exploded higher. So obviously investors are interested in such markets today, because you know fundamentals is one thing, but investors are looking for markets that could replicate the GameStop phenomenon, and therefore the question is there any market like this left on commodities? So here we have a quick overview of the most commodities, and you can see that many of them rallied hard, so they're already expensive. So which are left behind? So certainly it's Palladium, which is a yellow line here. The problem here for Palladium is that it's among the precious metals. It's not really a precious metal like gold, because it's mostly used in industry, and this is a chance for this metal. However, it is classified as a precious metal. So obviously with rising bond yields and the environment, like we discussed with gold, I think last week or 2 weeks ago as well, it's not favorable for Palladium prices. However, if you compare it to platinum, which rallied really strong over the past year, Palladium was nearly flat. So this is a small market. It's easy to pull it up if there is serious capital. Like I say, it's widely used in industries. So this is at least one candidate that didn't move. The other candidate is cocoa, which lags behind other soft commodities like coffee or sugar. Coffee has been down recently, but still it moved much more than cocoa. Obviously, like I say, it's not about the fundamentals today, because if you look at cocoa prices from the fundamental perspective, and if you ask yourself, is there upside? Is there a really strong upside for this market? You'll answer yourself no. But that's the case again if you compare to the situation to this GameStop stock, and you ask yourself, was there any upside fundamentally? Then certainly there wouldn't be much, and certainly compared to what happened eventually with prices. All right, and last but not least, let's take a look at the euro dollar and possible impact of the ECB meeting. As you can see, euro is down for another day, so we can say at last, because we were saying over the last couple of weeks that the upwards movement in US bond yields is positive for the dollar, but after a first impulse wave here, it failed to materialize, and we had this consolidation, and we actually had a day 2 weeks ago, or slightly less than 2 weeks ago, where bond yields were rising and the euro dollar was rising as well, which really left me puzzled. But it seems like the stop losses were cut here, and after they were cut, the serious capital turned away, and the second leg of this structure started to be printed, and we are moving along. Probably not so much potential left here of at least this move, because the range is low 80s, so it's not so much, and last week was much more, and we actually discussed this flag as well. But at least from the ECB perspective, it looks like it gives them some comfort of not following on their recent jawboning, because they were saying obviously that they don't like the bond yield rise in the eurozone, that they will be ready to counter it if required. But the thing is, with the ECB already out of ammo pretty much, all they could do is to even further increase their bond buying programs, which will do very little for the economy, which will make the markets even more dependent on them forever. So with envelopes of these bond buying programs still significant, is there a need to do anything? No. If they do anything, it will be to show market that, well, we do not tolerate a rise in bond yields. But I think they will end up with just verbal interventions trying to talk down these yields, because they should be already at least happy with this move on the euro dollar here. So I wouldn't expect too much from the ECB this week, but we'll see. The meeting is on Thursday, and US inflation for February, it's on Wednesday, and these are the two most important events for this week. Okay, so ladies and gentlemen, thank you for your attention today. Please make sure to stay with us with the news section that you can watch every day, read every day in Xstation mobile platforms, where we try to cover markets for you, and we see each other next Monday at 7:30. Have a good week. Bye.